And as we count down to India's union budget on February 1st, we put the spotlight on Big T. Yes, we are talking about taxes, more specifically taxes which are linked to market returns. Take a look at this next report to find out more.
As India counts down to its annual union budget, equity investors at home and abroad are focused less on the direction of the market and more on what remains after taxes. Equity investors in India are subject to long-term capital gain taxes, short-term capital gains taxes, and security transaction taxes. Well, first up, let's focus on security transaction taxes. STT is a levy charged on the value of securities trades executed on Indian exchanges. It applies regardless of whether a trade makes a profit. It was originally designed as a low-rate substitute when long-term capital gains were exempt. STT now adds friction to every buy or sell order. Recent rate increases have pushed up execution expenses, affecting high turnover strategies and retail participation alike. Long-term capital gains tax is charged on profits from equities held beyond a defined period, which is 1 year in India. India taxes these gains at a flat rate once returns cross a threshold. For long horizon savers, pension funds, household investors, and global allocators, it directly shapes net returns and the incentive to stay invested. Even modest rate changes can compound significantly over years. Short-term capital gains tax applies to profits from assets sold within a shorter holding window. Higher rates raise the cost of tactical moves and portfolio rebalancing for retail investors using systemic plans. This can penalize necessary adjustments and reduce flexibility. The investor community in India is expecting a more streamlined structure to equity taxation as the country's retail participation has surged in the last few years. Foreign investors will also be watching India's tax policies as it could divert capital towards markets with simpler and more transparent regimes. Bureau Report, WION World is One.